In this video, I want to share with you a very simple and very clear approach to working on the platform, which also works well even for beginners, because it consists of two indicators. But also, in this video, I want to talk about an indicator that is unknown to many traders, which is called the Double Exponential Moving Average, which helps us solve probably the most important problem of the moving average. It's lagging, real lagging from the trend. Here you have three moving averages with a period of 100 plotted on the chart in front of you. That is, all these moving averages show the average over 100 candles. And usually moving averages are used in such a way that when the chart is below them, we open trades downwards. When the chart is above the moving average, we are mainly looking for entry points for upward trades. But you can see that all three lines, even though they have the same period. That is, they count the average over 100 candles. These three moving averages move very differently, and they react to the chart very differently. In blue, we have a normal moving average. That's how it reacts to chart movement. As you can see, the actual upward trend in this case started at this point. But the moving average really started to reverse only here. We missed about half of the trend. And if you look at just this one movement, we missed it almost entirely. Therefore, we have an exponential moving average plotted in red. What does exponential moving average mean? It means that it reacts more acutely to chart changes because the last candles have more weight in the calculation of this average than the previous ones. And this mitigates the major problem with the regular moving average in that, you see, the exponential moving average reacted faster to the trend than the regular moving average. But we have a way that will show the trend reversal even brighter, even more accurately, and better track its movement. This is the double moving average, or DEMA, double EMA. As you can see, there's an exponent effect in the double moving average calculation. The effect of the last candles having more weight, it is doubled. And as you can see, the green candle will react even more sharply to the change in trend. As you can see, the reversal of the double exponential average happened at this point. At this point, it conditionally begins to indicate a trend reversal. And as you can see, it's much faster than a simple moving average than an exponential moving average. It's worth noting here that sudden change with the chart and low lag is not always good, because sometimes it will react to the chart too sharp, will give false calls, and so on. But specifically for our approach, the double moving average indicator fits better simply by the results of testing. I replaced this approach with a regular moving average on 100 trades and a double exponential moving average. And the double exponential average showed the best result. The second indicator that will be used in our approach is the supertrend indicator, which is familiar to many. The supertrend indicator is another trend indicator that helps you to look for specific entry points more quickly and on a more tactical level. When we see a slight change in the chart when it crosses the supertrend signal line, it changes color to the opposite color. And in fact, even a beginner can understand what message the supertrend indicator is giving now. When the signal line is green, it is a motive for trades up. And when the color of the line changes to red, it is a motive for trades down. And let's put both indicators on the chart now, and I'll tell you how we're going to use them. To start with the double EMA indicator. We need to add it to the chart with a period of 200. This is the only parameter change we apply. As you can see, the chart has become smoother because it now calculates the average over 200 candles. The second indicator is supertrend, but we use it also not with standard settings. In the period in it, we change it to 12. Specifically for this approach, I also suggest changing the color of the moving average to neither green nor red, so that it does not merge simply with the supertrend indicator. We could just change the color, like blue. So the basic rule of this approach is, first, let's look at how we use the double moving average, and we use it as a trend separator, which means when we have a chart above the double moving average, such as in this case, we only consider supertrend up entry points When we have a chart below the 200 moving average, such as in this case, we only consider down trades. Another very important rule for this approach is that a super trend change must occur after the chart has already crossed the moving average. This is what we can count here. Although a good trend, we wouldn't use this entry point because it came in when the chart was under the moving average. So we are only looking at upward trades, and here we have an indication of a negative trend. So this point for entry, we skipped. But if there was a change in the super trend, reading from red to green, right here, this is where we would have entered the trade. Here's a clear example of the deal is correct. That is, we now have a chart under the 200 double moving average in the super trend indicator changes color from green to red. Now we have both indicators coincided in readings, and now we can enter the trade down at this point. Stop loss is generally recommended to be set first at the peak of the super trend indicator. You see, there's a cog here. We can set a stop loss here and then move it along with the red line of the super trend when the super trend has redrawn its line. We can move the stop loss here and then here, and then here, and then here, and then here, and already at these points. Even if the deal suddenly closes at stop loss, it will close in our favor. This is what is known as stop trading. So in order for situations under this approach to be considered correct, exactly two of these asset chart events must coincide. If it is under the 200-day double moving average, then we are only looking at down trades. For example, in this case, we have a chart under the 200-day moving average, and the indicator has rapidly changed color to red. And as you can see, the timeline worked out great. Here, the approach is very simple. Here's a good example of going up. As you can see, right here, the super trend chart changed from red to green at the moment the chart was above the 200 moving average. And here we got a clear call, literally at the very beginning of the trend, that now is a good point to enter upwards. At this point, open when the first candle closes, when the super trend change is already fixed. This is where we come in. And as you can see, we caught some very long and very good trends. Stop loss moves together with the super trend line, and we move it first to these values, then further. And as you can see, stop loss did not work here. It entered only here, and we recorded a big plus on that movement. A very simple approach that is also suitable for beginners. And because it is visual, and the readings of these indicators are difficult to read in a double ambiguous way. That is, there are clear visual entry points that you can use in your work on the platform. Be sure to try this approach and share your results.